This is an interview with Ed Morris, the president and founder of HomeFirst Mortgage Services LLC in Hampton, New Jersey. Ed has worked in the mortgage industry for 28 years and is licensed in New Jersey, Pennsylvania, and Florida.
What type of mortgage programs are available?
The most common loans are conventional fixed rate mortgages and conventional adjustable rate mortgages, or ARMs. The fixed rate mortgage has typically been the most popular as the interest rate and monthly principal and interest payment will never change throughout the lifetime of the mortgage. The term of the loan is typically anywhere from 10 years to 30 years, keeping in mind that the longer the term, the lower the payment will be. The stability of this payment is why the option is so attractive to many buyers, and it allows the homeowner to know exactly how much needs to be budgeted for every monthly mortgage payment. The adjustable rate mortgage has been popular at different times throughout the years. The interest rate is typically lower for the first few years than that of the fixed rate mortgage. This allows the homeowner to keep the payments a little lower during the first years of home ownership. After the initial period of a low rate, which is typically 3, 5, 7, or 10 years, the rate will be scheduled to adjust. The adjustment can go either higher or lower, although typically, but not necessarily, the first adjustment will be in upward direction. Most of these ARMs have caps as to how much the rate can increase or decrease each time it adjusts. Because of the adjustment of the rate and potential increase in monthly payments in the future, a homeowner should be sure to understand both the benefits as well as potential drawbacks of the ARM program.
I've heard about an FHA loan. What is that?
An FHA loan is a mortgage program insured by the federal government, which allows for a little more leniency in the underwriting and approval of a mortgage loan request. The FHA program is a great option for low down payment loans, as low as 3.5%, as well as buyers who may have some blemishes on their credit report and therefore may have below average credit scores. The FHA loan is available as a 30 or 15-year fixed rate or as an ARM as described previously. These loans also require that a mortgage insurance premium is paid upfront, as well as an additional insurance premium included in the monthly payment. The amount of the upfront mortgage insurance is 1.75% of the mortgage loan amount and is typically added to the amount borrowed rather than paid out of the pocket by the buyer. The amount of the monthly mortgage insurance is dependent on the loan to value. However, it would be either 0.8% or 0.85% of the loan amount, split into 12 equal installments and added to the monthly payment.
Are there any other loans available?
Yes, there are several other options to consider, including a VA mortgage program and the USDA mortgage program. Each of these programs have certain benefits if the buyer is properly qualified for them and should be considered when making the final determination as to which program is best.
So, what program would be best for me?
Each buyer's individual and unique financial circumstances will help determine which program is the best. This is why speaking with a mortgage lender is very important prior to beginning the home buying process. After reviewing your full financial picture, your mortgage lender will be able to help determine which of these products best suits your needs.
And how do I submit an application for mortgage?
After you have found a home and have made an offer which has been accepted by the seller, you will need to contact the lender to start the official application process. Your lender will let you know if any additional items need to be collected and forward the application documents to you for your signature. You should always read and review the documents that have been provided to you, as they reflect very important information about your loan that you should understand prior to signing. Also note that you are never obligated to complete the mortgage transaction just because you have submitted an application to a lender.
Are there any upfront costs when I submit a mortgage application?
Typically, the lender will charge upfront for an appraisal fee and a credit report fee. Other lenders may charge other fees. It is up to the lender to determine what fees are charged when the application is submitted.
What is the next step after submitting a mortgage application?
After submitting the application, your lender will provide to you several federal and state-specific application disclosures, including a loan estimate reflecting the estimated amount of costs that will be due at closing. These disclosures will need to be reviewed, signed, and returned to your lender as quickly as possible. At this point, your lender will also order an appraisal on the property you are purchasing. The appraisal can only be ordered by the lender. You may be required to pay the cost of the appraisal at this time. The appraisal confirms the value of the home based on a licensed appraiser's inspection of the home and research of the current real estate market in the immediate area surrounding the home. This research will include recently sold homes that are similar to the home you are purchasing and what the sales prices were for those homes. These comparable properties will be a major determination of the appraised value of the home you are attempting to purchase. At this time, the lender will be reviewing your application and making a determination as to whether or not the application will be approved. Oftentimes, the lender will approve the request subject to conditions, which will have to be cleared before moving on to the closing. These conditions will typically mean that some aspects of your mortgage application were not completely explained and may need a little more clarification.
How much money will I need to bring to the closing?
This amount varies greatly from one transaction to another. Any down payment funds that were not paid prior to closing will be due at the time of closing. Also, if you chose to buy down the interest rate, the cost of that will be part of your closing costs. The loan estimate disclosure mentioned previously will provide the estimate of the closing costs and other fees that will be due at closing. You should review this document carefully and discuss it with your lender so that you understand the fees that you will see at the closing table. Fees that are typically due at closing are title insurance and title search fees, attorney fees, property survey fee, flood certification fees, a tax service fee, origination fee, escrow funds, per diem interest, as well as other fees that may be specific to your mortgage request. You should have a good estimate of the funds needed for closing very shortly after the mortgage application is submitted.
Ed, you mentioned escrow funds. What is that and how does that work?
An escrow account is simply an account that is established with the lender that will hold funds that will be used to pay your real estate taxes, homeowners insurance, and flood insurance if applicable, as these bills come due. Lenders will typically require this type of account to ensure that these payments are made in a timely fashion because there is more risk to the lender if these items are not paid. The lender will collect funds at closing approximately equal to 1/6 of the annual real estate taxes that are due on the property. This applies to New Jersey properties. Other states will differ. These funds will be deposited into the escrow account for the lender to hold until the taxes are due again. Likewise, the lender will also collect roughly 1/6 of the annual homeowners insurance and flood insurance premiums at closing and deposit it into the same escrow account. The tax collector and insurance companies will be informed that all future billings are to be sent directly to the lender for payment. Your monthly mortgage payments will include funds to cover your real estate taxes and homeowners and flood insurance, so as your monthly payments are received by the lender, an amount equal to 1 month of each of these items will be added to your escrow account.
What happens after the mortgage is approved?
When the mortgage request is conditionally approved, as mentioned earlier, a lender will contact you and let you know what steps need to be taken in order to move towards the closing. These steps could include providing additional pay stubs or bank statements, copies of canceled down payment checks, further clarification of employment and/or income, or any other number of other items. Your lender will provide you what these items are and guide you in providing the proper documentation for the clarification of these items. At this time, you'll also need to provide a homeowner's insurance policy reflecting sufficient insurance coverage as required by the lender. And you'll also need to provide a paid receipt to reflect that the first year insurance premium has been paid in full prior to closing. The buyer will choose the insurance agent and company, and the lender will provide any additional information that may be needed for the insurance agent. Once all of the conditions have been cleared by the lender, you will be ready to set the closing date.
And Ed, how quickly can a closing be scheduled?
The closing can be set roughly a week in advance. This will vary slightly from lender to lender. However, before closing can take place, a closing disclosure form must be made available for review to the buyer no less than 3 business days prior to closing. This is the final document that will reflect all of the monetary information in this transaction. This will include the amount of funds that have already been deposited with the seller for down payment monies, as well as any additional down payment funds that are still owed, any and all fees that are due to the buyer's representatives, such as the attorney, title company, lender, surveyor, appraiser, and others as required. This disclosure also reflects the terms of the mortgage, including the loan amount, the length of time of the mortgage, the interest rate, whether the rate is fixed or adjustable, what the rate could adjust to in the future if applicable, and many other terms specific to the loan. Finally, it will reflect the exact dollar amount the buyer will need to bring to closing, typically in the form of a certified or bank-prepared check. Because of all the information included, the closing disclosure is a very important document and should be reviewed closely with the lender and closing agent to be sure it is fully understood. By regulation, the loan cannot close until 3 business days have elapsed after the buyer acknowledges receipt of the document. Therefore, it is imperative that the buyer review this form in a timely fashion.
What actually happens at the closing?
Closing day is an exciting time and can sometimes be a little overwhelming as well. Typically, the buyer will schedule with the realtor a walkthrough of the home to be purchased early in the morning to confirm the seller has maintained the property and left it in the condition that was agreed upon. Sometimes this walkthrough may be scheduled for the day before closing if schedules dictate. The buyer will need to be sure that they have secured the bank check for the amount that is due at closing and be sure to bring it to the closing. The buyer will need to provide a government-issued photo ID, typically a driver's license or passport, to confirm identity. The closing agent will have all of the documents that will need to be signed by the buyer and will instruct how and where the buyer needs to sign and date each document. At this time, the buyer should review the documents being signed and ask any questions that may come up to be sure everything is understood. There are numerous documents to sign, and some need to be signed multiple times. The closing itself will typically take roughly 60 to 90 minutes for all documents to be signed and questions to be answered. Once all the documents have been signed to the satisfaction of the lender and closing agent, the transaction will be complete and the keys of the home should be handed over to the new owners. At this point, it's time to say congratulations and best of luck in your new home.
Ed, I want to thank you for this time and going through this information. If someone has additional questions, how could they get a hold of you so that you could talk to them about any specifics?
It's been my pleasure answering these questions, and I appreciate the opportunity to do so. Anybody can contact me in my office. My phone number is area code 908-735-9970, extension 223. And I'd be happy to answer any questions and help everybody along in the home purchase process.
HomeFirst Mortgage Services LLC, NMLS number 108395, is a licensed mortgage broker with the New Jersey Department of Banking, the Pennsylvania Department of Banking and Securities, and the Florida Office of Financial Regulation, and places loans with third-party lenders.
Securities and insurance services offered through Royal Alliance Associates, Inc., member FINRA SIPC. Insurance services may also be offered through Harbour Master Diversified Financial Services, Inc. Advisory services offered through Investment Advisors Asset Management LLC, a registered investment advisor. Royal Alliance Associates, Inc. is not affiliated with either entity.